Hello, everyone. I'm Haydn Zeis, and I want to welcome you to the Raising Returns Real Estate Podcast, where each one of our guests provide you with valuable knowledge from their unique take on real estate investing. And we're here to teach you how to raise your returns. This week's guest is my friend and business partner, Kelley Treon. She's a CPA, and she started her career at Price Waterhouse, and then went on to Borden Inc. as the Director of Internal Audit and Director of Financial Planning and Analysis. She's created new essential departments and was responsible for large deal analysis and M&A work. Kelley has run a successful tax practice for several years, but most recently co-founded Lonicera Investments, a real estate investment company. Kelley, thank you so much for being here.
Hi, Haydn. Hi, everyone. Nice to be with you today.
Kelley, I appreciate you coming on, and I wanted you to give our listeners a little bit more about your background and tell us how you got into this business of real estate and ended up working with two crazy people like Sean and me.
Maybe it's because I'm also crazy. I don't know.
I like that.
Well, as you detailed, I started out in public accounting. I was an auditor, and I was in public accounting for 7 years. And then I went to work for my largest client, which was Borden Inc. Borden has since changed its structure, and it doesn't really exist in the same form as it did back then, but it was a large Fortune 50 conglomerate, and I had various roles while I was there, but one of the roles that you mentioned, which I find is really helping me in my role with Lonicera today, is when I was Director of Planning and Analysis, I was part of many of our due diligence teams. And after I left Borden, I went into practice with my dad, and I was a tax advisor. I did estate and small business tax preparation, tax planning, and also individual taxation. But even then, I would get involved in my clients' transactions, reviewing them, helping them to perform due diligence. And so all of those things, all of those experiences I had in corporate America and in my private practice are really serving me today. I always had an interest in real estate. I owned real estate. I practiced out of a commercial building in Gahanna, Ohio that I owned. And recently, within the past 3 or 4 years, I started acquiring more commercial property that I manage and, hold for investment. I recognized that the skills that I had from being a CPA and from working in public accounting and working as an auditor and as someone in charge of budgeting, planning, analysis, those skills helped me in real estate. And I understood a lot of the aspects of real estate relating to not just how to analyze the financial side of real estate, but just understanding the entire transaction and where risk might lie. So anything, as an investor, anything that you invest in, you want to try to minimize your risk, whether it be a stock or a bond or a piece of real estate or a business, whatever it is. You want to understand what drives the business and where the levers are that can trigger risk. So when I met you, Haydn, through a real estate transaction that I did a couple of years ago, and you and Sean were already thinking about starting to put together an investment fund where you would pool investors, accredited investors who understood real estate and who wanted to be exposed to the diversification of real estate and the cash flow, but didn't really want to manage it on their own. I could see a fit there. I could see where my skill set would augment the skills that you and Sean already had. And so really, in short, it made sense, and we formed our partnership, and away we went.
Yeah, and I mean, working with you really added something to the Lonicera team that wasn't necessarily my best skill set. I know how to go through the numbers. I know how to look at numbers, but it's always good to have somebody that has the experience of going through with a detail-oriented mindset. And now, one of the consistent things that people on the show have said over and over is you've got to know your numbers to be successful. And one of my favorite quotes is you've got your known knowns, your known unknowns, and then you have your unknown unknowns. And it's the unknown unknowns, right, that get you. But now at Lonicera, I know you have kind of led the team as far as creating the proprietary model that we have, and that model is only as good as its assumptions. So could you kind of walk us through how you might take a deal, analyze it, and what the criteria that people would want to look for to make sure the deal works for them?
Sure. So as you mentioned, we have a model that we use. It's a very advanced, albeit, but it's an Excel spreadsheet. And we take the financials of any prospective property that we're looking at acquiring, and I put those into our model, and then I try to stress those numbers. So typically we're looking at properties that have some tenant base, maybe some vacancy, but generally we're looking so far at properties that have tenants. And so I'll build in a factor for vacancy. What if vacancy goes up more than what it is now? What are the rent increases that are in the leases that we have? Do we have fair market value leases in place? And if not, if we lost a tenant and we had to go out and find a tenant at fair market value, would that be a good thing or a bad thing? Would our cash flow go up or go down? So I have assumptions built in for risk factors, basically, and for things that we know are going to happen. Properties need to be maintained. We have to build reserves for when the HVAC units need to be replaced, when the roof needs to be replaced. These things will happen. We don't know when. When we look at a property, we try to guess when, and that helps us value how much we want to pay for a property. But our model tries to take into account all of the risk factors, controllable and the ones that we can't control, and we try to quantify the risk factors to determine if things go in a certain way. And Haydn, we'll run it several different ways. Best case scenario, worst case scenario. If things fall a certain way, will we still be able to provide a return to our investors? And that's really the bottom line. Will there be enough cash from the operations of the underlying properties, tenants paying rent, expenses being paid, to return on investment to our Lonicera investors? And it's pretty detailed. We take into account the type of property, the type of tenant, the industry that the tenants operate in, the risk factors of those industries, whether or not we're using a third-party property manager or we're managing the property ourselves, whether or not has been high turnover in the property. We might build leasing commissions in if the leases are not long-term. So there are a number of factors, and all of them we try to provide a numeric estimate of how those factors will impact the overall return generated by a potential investment.
From what you're saying is we're putting assumptions into this model, but these aren't really necessarily assumptions. I mean, it sounds like, we know that real estate has been around for a long time, and the things that you said you were analyzing were your knowns. We know that the property is going to need maintenance. We know there will be a vacancy factor, and then you'll take a look at the tenant and their viability and how much they may succeed or maybe not succeed, and you take all of that into account and throw it into this model.
That's right. And to your point about known unknowns, or more to the point, the unknowns, we're trying to minimize, so we're trying to think the entire range of possibilities that might occur, and then the probability that they might occur. So, and by the way, good insurance, having and carrying good insurance on the property is a way to mitigate a lot of those
Sure.
possibilities. So that's always a factor we consider. You're right. We know there's always going to be vacancy. If it goes up or down, we want to understand what that looks like. And part of it is because we disclose these things to our potential investors. They have a right to know the risk factors and how they might be personally impacted. So You're right. We're taking our experience, turning that into educated guesses, and then building that into a numerical model so that we can present a pro forma picture looking, here's what we think this property can return.
I think going through and looking at the facts is one of the most important things. Now, when you're going through a model like this, what do you find as some of the challenges that you're going when you're trying to fill out the information on the model? Do you think that you may have missed out on a deal because you've either overestimated the expenses, or what challenges, I guess, are you seeing when you're going through looking at these models?
Yeah, and I think that's where you're right. The model is not perfect. We use it as a tool. It's an indicator only, and it's written all over your investment statements and all over our legal documents that past performance is not necessarily an indicator of future results. So yeah, you can talk yourself out of a deal by building in an extremely rainy day scenario, and that's where it helps. I think in our partnership, having you and Sean and I all looking at it, and all of us having experience and maybe coming from different perspectives and trying to decide, yes, we could lose all of the tenants, but what's the probability of that happening? Because running in the background of all of this analysis is, if you don't buy a property, your return will for sure be zero. So we're trying to make good guesses so that we are pretty close to what is the most probable thing that might happen so that we can make a good decision. Sometimes what you thought was a good decision doesn't turn out to be so, but we're not going to make that decision without having considered as many facts as we can possibly get. And that's, you said, what's challenging. Sometimes we're looking at properties where the owner is not a good record keeper and doesn't do analysis like we do. When it's someone who's owned the property for their own benefit, so they didn't have a partner or third-party investors, and maybe even in a lot of cases, didn't even carry a mortgage on the property, so that they're not answering to a bank or anyone, just themselves, they tend to not monitor and analyze like we do. We have a fiduciary responsibility to our investors, and so we go at it in a very detailed way. And I'm sure you can think of examples, and I know I can, of times where we were looking at potential investments where the data was it was hard to understand what actual expenses were because they hadn't been segregated or tracked.
Mm-hmm.
But even when that happens, that's when we rely on our experience, and we have access to a lot of market data and market research. And so we'll just try to create something that's reasonable for a property of that size and type. And we'll understand that our estimates are as close as they can be without having tons of detail. And that's another thing that I should mention. When we're performing our due diligence, we're not doing an audit. There's not time for that, and audits are expensive. So you're trying to do as much work as you can while still being cost effective, and you're running against the clock, right? Because you're in competition with other people for these properties. So you're kind of trying to get to the finish line being able to make an offer on the property around the same time as the other people, or ideally before, with an offer that is good for your investors and good enough for the seller that they want to take it.
Well, I think running in when you're going through analyzing the deal, maybe before you put an LOI, you want to get, and this is a good piece of advice for the listeners who might be making an offer or looking, but you want to have as much information as you possibly can before you make your offer. Because when you're making an offer and you're going back and forth through the negotiations, the seller is not going to want to deal with retrading, meaning they're not going to want you to say, well, we want a lower price because of this, this, and this. It doesn't necessarily work. So if you can get as much information ahead of time before you make that offer, then at that point it makes sense to make a legitimate offer. But like you were saying, in some cases that just does not work. They don't have good records. You don't get enough information up front, and sometimes you're kind of forced to just put the offer in, and then that's when you get into the actual due diligence period where you start doing the digging. In most cases, information will turn up during that time, and I know you and I have talked. There has never been a due diligence period where I have gotten the accurate information up front. You always uncover something during that due diligence period. And sometimes it's insignificant. Sometimes it's millions of dollars worth of capital that was not put into the analysis that you received. So
that's right.
And so, it's kind of ebbs and flows, right? When you're making your decision on when to put an offer in. But I think overall, like you were saying, know the numbers up front before you even put the offer on the deal. Well, Kelley, thank you so much for being on the show. We really appreciate it. You can reach Kelley with any questions that you might have at Treon at lonicerainvestments.com. That's KTREON at Lonicera, LONICERA investments.com. Now, make sure you subscribe and share this podcast if you find the information valuable. As always, to all of our listeners, we really appreciate you joining us, and we'll be back next week with more real estate insights. Thank you.